New York City has been one of the hardest hit cities in the entire US over the past year, with vacancy rates for office, retail, and hotel properties seeing massive year over year spikes, and multifamily seeing close to double digit percentage point rent declines year over 2019 figures. Back in March and April of last year, headlines flooded the news citing the death of New York City, with many people throwing in their 2 cents on what they believed would be the fate of the largest city in the US. And at that time, these articles were all speculation when it wasn't clear whether or not the mass exodus from the city would be short lived or would become a more permanent shift in consumer and business demand away from the metro. But today, almost a year later, we're starting to get a much clearer picture about how New York has been affected by all of the events going on today. And in this video, we'll dig into the data behind what has really happened to the largest city in the US over the last 12 months and what the future might hold for the Big Apple going forward. So I grew up in New York, just a few hours outside of New York City, and the city was always a thing. New York pride is very real, with the endless opportunity to build a career, meet smart, ambitious people, and be at the center of a city that never sleeps. New York City has always been one of the most iconic and exciting cities in the entire world. But in March of last year, that all changed, and all changed really quickly, as New York was one of the first cities in the country to issue stay-at-home orders and shut down office spaces, restaurants, and almost all real estate related indoor venues. And with that, seemingly overnight, offices moved almost entirely to remote work, restaurants and bars shut their doors, and things that made New York City what it was all went away almost instantly, which suddenly led to people who were paying several $1,000s a month for a shoebox apartment to reconsider what they were paying for in the first place. And that led to a massive shift of people moving out of New York City in 2020. And as we talk about on this channel a lot, net migration patterns drive real estate demand. And when real estate demand drops, this puts downward pressure on rents and values in a market, which is exactly what happened in New York City last year in almost every major product type. And after 12 months of seeing this play out in the metro, the verdict is starting to come in around how New York City has fared and how the metro might continue to perform going forward, and if New York City is in trouble long term. So among all the commercial real estate property types, not surprisingly, hospitality, retail, and office were all hit the hardest, with multifamily not far behind. According to PwC data, Manhattan hotels saw year-over-year vacancy increases of over 68% in November of 2020, a year-over-year decline in RevPAR, or revenue per available room, of 85.2%, and almost 6,000 rooms reported to close permanently in New York City as of December of 2020. In the fourth quarter of last year, the market average occupancy for Manhattan hotels was just 30.1%, with the average daily rate in the city dropping from $311 in Q4 of 2019 to just $137 in Q4 of 2020. Not surprisingly, retail also took a huge hit in the market, with a lack of tourism and the inability for many stores and restaurants to even operate under government orders resulted in a major hit to sales figures and profitability for many New York retailers. According to CBRE data, foot traffic in Manhattan below 96th Street dropped as low as 15% of 2019 figures and hovered around 45% of 2019 numbers for the majority of 2020. And according to Cushman & Wakefield's Q4 2020 Market Beat report, retail asking rents in Soho dropped by 21.6% year over year in Q4 2020, and retail availability reached 29.5% in the submarket, while Madison Avenue retail rents between East 57th and East 72nd Streets dropped by 16.2% year over year, with retail availability in that pocket of the city jumping up to 39.2% in Q4. And obviously, office was another big loser of the events of 2020, with new leasing activity throughout the year registering an all-time low of only 12.8 million square feet in New York City, according to Cushman & Wakefield research, and vacancy hit a 26-year high of 15.2% in the city. Overall, vacant office space in New York hit 61.4 million square feet, the highest total on record since 1994, and sublease space hit a record high of 19.3 million square feet by the end of 2020. Net absorption figures were also hit hard, clocking in at negative 7.7 million square feet, according to Newmark data. And according to CBRE, daily average occupancy of office buildings in Manhattan overall was just 10 to 15% as of earlier this month, according to key card swipe data. And while the demand for hospitality, retail, and office real estate fell off a cliff, the apartment sector quickly followed suit, with multifamily net absorption in Q4 of 2020 hitting a negative 2,600 units in New York, rents in the market dropping by 9.7% year over year, and the overall sales price per unit in the market dropped from $366,000 in 2019 to just $322,000 in 2020, a 12.1% year over year decrease. Historically, people have come to New York City for the career opportunities, the ability to meet new people from all walks of life, and a fast-paced atmosphere where there's always something to do, regardless of the day of the week or the time of night. But with career opportunities becoming remote work arrangements, events being canceled, and bars and restaurants struggling to keep their doors open, the vast majority of things that have traditionally made New York City have gone away, at least for the time being. And because of this, over the last year, individuals and businesses have started leaving the city in droves, looking for a lower cost of living, lower taxes, and fewer governmental regulations and restrictions influencing everyday life. Miami, Florida has been one of the most popular destinations for New Yorkers, with a lack of state income tax and year-round sunshine driving companies and their employees down to South Florida more than ever before. According to a February article in Multi-Housing News that analyzed data from location analytics firm Unicast, Miami saw over 300,000 New Yorkers move into the metro between mid-March and September of 2020, which was the second highest move to area for New Yorkers during that timeframe. And aside from individuals that can now work remotely moving south, many companies are also leaving New York City, with Blackstone signing a 41,000 square foot lease late last year in downtown Miami, $41 billion hedge fund Elliott Management moving its headquarters to West Palm Beach, and reports that Goldman Sachs is considering a move of their asset management division to Palm Beach County or Fort Lauderdale. And while this was all exacerbated by the events of 2020, this shift in migration patterns wasn't necessarily new, and like many other trends that went into overdrive last year, the shutdowns and closures that happened in New York City may have just accelerated some trends that were already happening in the metro. Office vacancy in New York City has ticked up gradually since 2015. Office rents have stayed almost completely flat in the market over the last 6 years, and other big-name Wall Street firms like billionaire Carl Icahn's Icahn Enterprises had already moved their headquarters out of New York City by the time March of 2020 rolled around. Retail rents in Manhattan have also been flat since 2015, with some areas of the city actually seeing substantial decreases in rents over the last 6 years, with Midtown retail rents dropping a total of 33% from the first quarter of 2015 to the fourth quarter of 2020, with the vast majority of that drop coming from 2015 to 2019. Even multifamily rents in New York have been steadily dropping since the mid-2010s, with Zumper multifamily data showing that rents for 1-bedroom, 2-bedroom, 3-bedroom, and 4-bedroom units have all been consistently decreasing in New York City since 2015 as well. This is all to say that, similar to the e-commerce and remote work trends that picked up so much steam in 2020, the decline in New York City real estate demand isn't necessarily new, and everything that happened last year seemed to merely accelerate the process rather than trigger a brand new trend overall. New York County has seen negative net migration every year since 2011, with steeper net migration figures being posted every year as people and companies leave the metro in search of lower tax environments, lower costs of living, and warmer weather overall. But with all of that said, and New York seeing some of the toughest times it's ever seen, that doesn't mean that I'm necessarily bearish on the metro long term, and it's hard to believe that the city won't bounce back in the future, even if it might be a while. As I mentioned earlier on in this video, New York pride is a very real thing, and for a young person willing to hustle and work hard, there aren't many other places in the country that can rival the kind of opportunities that New York City offers. New business applications in New York State actually hit record levels in Q3 and Q4 of 2020, and while many companies are moving out of the city, some other big names are creating an even bigger office and retail footprint in the metro, with Facebook signing a 730,000 square foot lease next to Penn Station in August, TikTok signing a deal in May to occupy 232,000 square feet in Times Square, the Home Depot signing a lease to occupy a 120,000 square foot retail store on the Upper East Side in Q4, and Target signing a deal at the end of last year to open a 27,600 square foot store in Soho. Now, there's always a case to be made that this time is different, and it very well may be, but New York has bounced back from tough times before, and the supply and demand fundamentals the market had coming into 2020 still made it the most expensive market in the country for a reason. And for investors that believe in the long-term fundamentals of New York City, we might be looking back at 2020 and 2021 and seeing this as one of the best buying opportunities in the market in history. And for local players that understand the market and have strong leasing broker relationships, there could be a lot of opportunity throughout the rest of the year to backfill well-located space with retail or office users looking to expand in the market at a time where it's actually affordable to do so. Overall, I just can't see New York City dying long term, especially since it really is the epicenter of US finance. And with the pride that the New York finance community has, it feels like it's really not a matter of if that demand will come back in the future, but when that demand will come back in the future. So I hope this was helpful if you're curious about what's happening with New York City real estate and if the headlines are correct. And if you want to learn more about how to analyze real estate investment opportunities that might come your way, whether they're in New York City or another market you have your eye on, make sure to check out Break Into CRE Academy, which includes courses on real estate investment analysis, pre-built acquisition and development models for multifamily, retail, office, and industrial deals, and additional one-on-one career support if you're looking to break into the industry and want some more hands-on individualized support to help you land a role at a top real estate investment, brokerage, or lending firm. And if you like this video and want to see more videos like this on specific markets on this channel, make sure to hit the like button to let me know. And also let me know in the comments what you see as the future of New York City real estate going forward. As always, guys, thanks so much for watching. I hope you found this helpful. Subscribe to the channel if you want to see more videos like this every week, and I'll see you in the next video.